Welcome to Straight Talk on Retirement, your no-hype source for financial advice and making informed choices about your retirement planning. Get on the phone to talk today at 969-KTRS.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Aaron Lapidus.
Well, hello, St. Louis, and welcome to Straight Talk on Retirement. You're live and local, St. Louis's favorite financial call-in show. I'm Jeff Lapidus, president of JBL Financial Services. Our offices are located in beautiful, sunny downtown Clayton, Missouri. I'm a 40-plus year veteran of the financial services area, a fee-based financial planner and wealth manager. And I'm joined this week and every single week by my very favorite, oldest, prodigal daughter, Aaron Lapidus, who also is a fee-based financial planner and wealth manager.
And we help our clients make smart choices about their money. The way we do that is by designing a game plan, a written step-by-step strategy, a real game plan that has several goals in mind.
First is to preserve, protect, and prudently grow the assets our clients have taken their entire lifetimes to accumulate. Second is to deliver a reliable stream of income, one that they can count on, so they can do all the fun things they'd like to do during retirement.
And third is cost-effectively addressing their health care needs, like helping individuals enroll in Medicare and choosing the right plan to supplement their medical coverage.
And then when they're done enjoying their assets during their lifetime, we show them how to pass them on to the people they love, whether it's their spouses or children, grandchildren, churches, or charities, whoever it might be, with Uncle Sam or the tax courts taking a big bite out of their money. And as their wealth managers, Aaron and I watch their money every single day to make sure they're staying on track. And that's why they call us the retirement coaches. Good morning, babe.
Good morn.
Another wonderful day in the neighborhood. You know, this is the nicest Saturday morning that we've had all year. Sun, it's clear. Warming quickly.
I'm so glad that you are so happy about this.
The day before the eve of the first
The day before the eve
of the first night of Passover. Yeah.
Yes, indeed. A week before Easter.
One of the ultimate Jewish foodie holidays, as it would be. And important remembrances. It's good. It's family. Mm-hmm. It's fun. It's connecting with people that you love. And, you know, being invited sometimes to your home or other people's homes for food. I mean, it's all good. But that's not what our show's about today.
It is
right?
not.
It is not what our show's about.
No.
We do want to remind everybody, though, that all of our clients are folks that are like you. They're over 55. They're getting ready to retire, or they're already retired. And when we create a game plan for them, so they can have a fun and hopefully financially successful and worry-free retirement. That's what it's really all about.
It is.
And our phone lines are open. We'd love to hear from you. 931-5877. Star 5877 from your cell phones, or 84126 from the text line. And as we like to do, we do remind you that you can keep up with Aaron and I during the week.
That's right. If you log onto our website, jblfinancial.com, you can click on the lower left-hand side of the screen where the pop-up box appears to sign up for our monthly newsletter. Or you can click in the upper right-hand corner, contact us, and send us a quick email, question, thought, or request for a coaching session.
And we do call that the Coach's Corner, easy to access, as Erin mentioned. And she and her staff do keep the last 6 to 8 months of those archived for your viewing, printing, or downloading convenience.
That's right. We're at the very end of this month, so I thought maybe we could spend this time going from discussing the questions that we received by text, yet last week we didn't get to.
Fabulous. Let's do it.
We have several.
And keep them coming, by the way. We'd love to hear from you. We always have a lot of things on our mind. What's more important is what's on yours.
Good morning.
Good morning.
I have the option to retire from my employer at age 55 with 80% of my salary until I'm 62, and then it drops down to 60%. My issue would be the insurance. My employer will reimburse me for insurance premium up to $2,000 a month. This will continue until I'm eligible for Medicare. My main concern is what type of plan I will have in respect to copays and coinsurance.
Who cares?
Right, with $2,000 a month, if you're an individual being insured, the most I've seen is about $900 in premium a month, which means that you would have $1,100 left over for out-of-pocket expenses to be paid by your employer.
And if you're married, still $2,000 a month is more than enough
to cover the premium, absolutely. No, I would not think that's a concern.
No, we should remind folks that for the first 18 months, they would have COBRA coverage. They can continue under the plan that they currently have. Those premiums probably are more than sufficient to cover.
Or potentially if they have the retiree plan, like if they're working for one of the larger like airplane manufacturers in the city or maybe a telecommunications company, they offer extending the coverage till Medicare eligibility, potentially.
You know, and again, the big thing here is that there's obviously a premium factor and there's also a deductible factor.
Right.
But it sounds like
you're going to have quite a bit of money so you would, I think the math would be if you are someone that doesn't use the policy very much, maybe you raise the deductible and then you have more of that money of the $2,000 left over if something happens. If you're someone that's in need of care on a regular basis, maybe you pick the lower deductible, you're paying more in premium, but you've got lower out-of-pocket expenses. But with $2,000 a month, that's an excellent benefit.
Well, and plus you're getting 8% of your salary, so.
Right. So also for most people, you pay co-pays out of normal cash flow. You don't have money set aside specifically for health care purposes. So if you're going to replace some of your income, you should be able to manage the out-of-pocket co-pays and things like that, just like you do now.
Yeah, so it's a math problem.
Right. Oh, there's another health insurance question.
Oh, big surprise.
Don't get too excited.
Surprise, surprise.
I have Aetna Medicare Elite, which is a Medicare Advantage plan. I'm going into the donut hole soon because of 2 drugs with no generics. Nearly hit catastrophic phase last year. Do the other plans provide better coverage, or is this standard dictated by Medicare? This standard, unfortunately, is... So Medicare sets the guidelines for the prescription drug policies, just like they set the guidelines for medical coverage under Medicare. So even if you're using a Medicare Advantage plan like Aetna or you have a supplement, they're dictating what the insurance companies need to cover through Medicare legislation. Medicare Part D prescription drug plans work the same way. They were introduced later into Medicare during the second Bush administration, and they leave a gap. So before the Bush administration, there was very limited prescription drug coverage under Medicare. So in order to expand that, what they ended up doing was creating a system where you have a tiered benefit in 2 ways. Your benefit's tiered by what type of prescription you're taking. Most people are familiar with that. You're on a preferred generic, you're a tier 1 medication, non-preferred generic, tier 2, and so on. But Medicare also tiers your prescription drug plans by price. So you have a deductible phase. Some plans waive that, like the Medicare Elite policy that, the Aetna Elite policy, rather, like the Texture has. They waive the deductible, so you get copays from day one. But then, as you move through the copay phase based on the retail value of your prescriptions, you'll enter what's called the donut hole, which is a gap in coverage. It's not no coverage, it is reduced coverage. So when we're talking about copays, that's a fixed dollar amount that is dictated by the policy that you've selected. When you go into the donut hole or the gap, you switch over to what's called coinsurance, which is a percentage dictated by the policy that you've selected. So a percentage of the retail value of the prescription in this particular case would be your coinsurance. After you've hit after you've gone through this phase of the prescription drug plan, you'll enter what's called catastrophic coverage, where your prescriptions are dramatically reduced in price, most likely lower than when you were paying copays when this all started at the beginning of the year. So unfortunately, some companies will create some coverage for you in the gap, meaning, most likely your name brand prescriptions are what pushed you there. If you're going to pay you're going to pay a percentage of the retail value of those prescriptions, they may still keep your other prescriptions lower. Like if you had a generic, they may still charge you $0 as opposed to starting to charge you for it, which is something that does happen to people in the donut hole on certain policies. So there are certain things that the insurance companies will do, but that's about it.
Well, I was going to say, I don't know if this was this is a question that I was reading from what the texter had given, which is with the Medicare Advantage plan, since the Part D coverage is packaged with the Medicare supplemental coverage,
mm-hmm.
you don't really have a choice of plans. I mean, it's called
right,
the
but
Elite plan offers.
But
this.
all the plans have the donut hole. It doesn't matter
I understand,
if it's
honey.
packaged.
I'm just
or not.
saying is that he couldn't do anything or she couldn't do anything to upgrade or improve their coverage with their current plan because it's packaged together. I mean, it's not like you have a choice of multiple lawyers,
right? You can't parse it out. However, when you are looking at prescription drug plans, the goal is not to avoid the donut hole because that's impossible if you're going to end up there. The goal is to keep the prescription costs as low as possible before you get there, or to make sure that all of your prescriptions are covered so you're not paying out of pocket for something and then also have your insurance policy separated. Unfortunately, you're not going to be able to avoid the donut hole if you are taking certain medications. Doesn't matter which you could just change from another to another Medicare Advantage plan. You'll still be in that same situation.
Yeah, I know as a part of your and your staff analysis is, you're looking at what these drugs are and what they cost.
Mm-hmm.
And based on someone's usage, you really can estimate what their costs would be. And obviously that's one component cost. The other component cost is the supplemental coverage and how do those two fit together so that somebody is able to reduce their out-of-pocket expenses truly and then obviously maximize their coverage.
Right. Or in the worst-case scenario, I find that people are much more comfortable if they know what is going to happen. So if, you are taking a medication that you need, there's no reason for you to change off it. However, it would be a little startling for you to walk into CVS or Walgreens and before you were paying $20 for it on your private health insurance and now all of a sudden they want to charge you $500 the first time. That's an unsettling number. Well, if you know going in what the prices are going to be and if you're working with an expert that can, take a look at your prescriptions, tell you what those are going to cost on the various options that you have available, you'll be prepared when you go to the pharmacy and you'll know what's coming, which will, either if you're working with a financial advisor, maybe this is something that you need to factor into your monthly expenses because they might be different than when you were working. Or maybe this is just the opportunity to decide, where is my true expense with my health insurance? If it's on the prescription side, then maybe we do our best to reduce premiums. So we're doing a little cost shifting. There are ways to contain costs or at least keep the, as you like to say, the water level, meaning we're not going to, you might have to cost shift a little bit, but we're not going to be taking any more out of your pocket. It's just you might be giving it to CVS instead of the insurance company.
And this is obviously a part of the analysis that you do for folks that are looking to transition to Medicare. Easy to get with our office on that, 314-863-0008, or send Aaron an email, aaron@jblfinancial.com.
We have received 2 texts about the same exact thing in the last several moments.
Well, it's because they listen to you.
Well, this is not even about Medicare, so it's even better.
Oh, it's better.
It's even more exciting than Medicare. It's taxes. Good morning. Is tax advice and financial planning included in your scope of work, or do we still need other advisors for withdrawal strategies, tax implications, etc.?
I think that's a very fair question, and I would also say that there's a gray line. Because of the education and training and the work that we do every day, we're involved very heavily with taxes. We're doing income projections for clients, so we're helping them and assisting them in trying to mitigate taxes
right,
by looking at their tax situation. We don't do tax preparation, however.
Right.
And
which was the other question.
Right. And we do, at this time, our office does not do individual tax preparation.
Correct.
And so therefore we standardly say we don't give tax advice, but
The reality is
we
because
do a lot of advising on taxes. I mean, that's
right,
what it comes
because
down to.
when we're making decisions about withdrawal strategies, which does
Big
fall
one.
within the scope of our financial planning, we have to factor in taxes depending upon what type of accounts our clients have and what type of accounts they're going to be withdrawing money from. Also, we have to consider long-term and short-term capital gains when we're making trades in accounts that have those implications. So we're constantly involved in taxes. However, we do work with our
Financial
own
professionals, right.
other tax professionals. We also work with our clients' tax professionals to make sure that we are following. If we have questions about the rules, we're going to get those answers.
Yeah, and to be honest here, most CPAs know the laws, but the thing is they don't really get actively engaged with the rules. So,
or the strategy, the
Yes.
actual implementation of the rules.
Sure. I mean, let's use a real simple example. If someone leaves their company, decides to retire, or they decide to terminate their employment, if they want to move their 401k assets into a self-directed IRA, well, that's potentially a taxable situation.
If you don't follow the rules.
Right. There are basically three ways to pull money out. We know what the rules are. You can take a check. If they'll cut you a check, they'll withhold 20%.
By law.
And we know that you have to put it back. If you want to put it back in, you have to do it within 60 days. Also, we know that the most effective way
to do a direct transfer.
Right. It's called a trustee to trustee transfer, going directly from your 401k to your new custodian who has set up that IRA account. Those are important things to do. We know how to do them.
Right.
Accountants don't get involved in them, but they do.
They do the recording of the fact that it happened.
And
or
there are
right.
And there are 1099s that are generated each year, and we
Right.
also notify clients about that. So when it comes down to the real life tax advice, that's what professionals, i.e. accountants, do. But advising on tax strategies is something that we actively do. So we hope that answered that person's question. Yeah. And we do have Sue on the line. Sue, good morning. Welcome to the show. Thanks for calling.
Guys. I love your show.
Thank you.
Got a question. If I put money, my grandson just turned 16. If I put money in an account for his to go to college, and then he decides, not to go to college, can I take that money out or something and not get penalized for it or something? Because I'm afraid that, can I take that money out or something and not get penalized?
Okay.
Excellent. So we'll answer this question.
We're going to do this one offline, Sue, to make it
Excellent.
easy for you, because we're getting a little reverberation. You kind of got two questions here. Number one is effectively saving money for someone else. If it's for a minor, you have a couple ways you can do that. Number one is you can set up what's called a custodial account, which is one where it's in their name.
But you're the account owner until they turn 18?
Exactly, in which case then they are able to take possession for it. What happens is any interest or dividends that are earned capital gains are taxed to you.
Until they take possession of it.
Exactly. That would be way number one. So that would kind of maybe help you.
Also, if you did something like that, there aren't any limitations on what he can use the money for or anything like that. So if he decided not to go to college, but he'd like to put a down payment on a house, there wouldn't be any penalties associated with that.
Or maybe, exactly. The second way would be is you can set up a special account called a 529 plan. This is an educational savings account. It's one where the money grows income tax deferred, as long as that monies are used towards somebody's education. They come out tax free. Now, one flexibility you do have, and you didn't tell us about this, but let's assume that this grandson I assume it's a grandson, or it could be a son that you have. If you have another child or another grandson, you could transfer that account to that other person's
Right, so
name.
if your first grandson decides that he's not going to college, you could say, okay, that's fine. We'll just wait for your brother or one of your other grandsons. You can change the name on the account, and then that money will continue to go tax deferred, and then your next grandson would have the opportunity to use it for college.
Right, and if you decide to bust the account, and if it isn't for education, then what happens is you pay a 10% penalty because you didn't use it for education, and it's ordinary income. The other thing is you could also change it back into your name and take
possession of
cooking classes in France or something. or do education for yourself.
That's true. Any type of advanced education is qualified for the 529.
So you don't have to use it or lose it, but with many situations that we see, and we encourage our clients, especially those that are in a situation where their kids are 1 to 2 years away, why move into a 529? You're really keeping it very, for a very short period of time. Why even create a custodial account where the money's automatically to transfer that child if you don't want to necessarily do that? Just set up an account in your name. Let it grow. Earmark it for them. Maybe do it as a TOD if something happens to you before they do it, and then you can make a decision on how you want to use the money in their benefit.
Right. Also, keeping the money in your name is important because if you have children or grandchildren that are applying for federal aid, I don't know the exact equation, but a much larger percentage of the child's assets are calculated in those financial
FAFSA,
in the FAFSA determinations than none of a grandparent's money is calculated into that. So
Exactly.
if a grandparent has set money aside for their grandchild, well, they can be the second payer essentially, as opposed to the first. You have a relative that needs a little assistance. They apply for FAFSA, for federal aid for education, and maybe they didn't get 100% of their tuition covered, or they need help with room and board. Well, you could still step in and help them out, and even still, it wouldn't be considered a gift if you pay directly to whom the money is due. So if you're paying directly to the university on behalf of your child or grandchild, anything like that, it's not considered a gift. So you would avoid anything like that.
Yes. And, again, this is in lieu of giving the money to the parents, per se, if this is a grandchild situation, because those assets then can also be included in FAFSA. So very good question. We do appreciate that. And it's fun,
Another text question.
Hello.
I've already filed my taxes for 2020, but have decided to fully fund a new Roth under my 2020 income. Do I need to amend my 2020 taxes?
I think you have to ask a CPA. I don't know the answer to that question.
I don't know the answer either because it's not pre-tax, so it wouldn't have affected what you owe, but it may still need to be reported. And I believe that when you make the contribution, the custodian, the bank in which you make the contribution, is going to send information to the IRS, because that's how they figure everything out, right? Your employer sends the information on your salary, you send in the information that they gave, the IRS matches it up to make sure that they match. Just like 1099s, if you're retired, pulling money from your IRA account, you get a 1099, your custodian's already sent a 1099 to the IRS. They want to match them up and say, okay, this matches. That's why you owe Y.
I think this could be a out of luck situation.
What do you mean out of luck?
Because I don't even know if I don't know if you can amend your return to do that.
I do not know either, because I know at least the rules with our custodian is you can only make the contributions before you filed your taxes.
Right. I got you. So again, this is definitely a CPA question, and you can always Google it if you want, right?
Right, or if someone prepared your taxes, you paid them, so go back to them.
Gotcha. Are you okay? Are you still have any more on the text line? Because I've got one over here.
You can go for it.
Are you sure?
Yes.
Okay, great. And again, our phone lines are open. We'd love to hear from you. 931-5877, star 5877 for your cell phones, or 84126 from the increasingly popular text line. Oh, how do I go back, Eric?
Oh, good grief.
No, I mean...
Hold on, we have technical problems.
No. Yeah, I don't even know. I don't know how to do that.
Well, we remember what the gist of the question was.
Yeah, exactly. The gist of the question, unless Eric is able to get this up quickly, and he's a dog. Beautiful. Keep on going.
This is quite exciting for the listeners.
No,
if only you all could watch this happen. Boomers and Technology.
Keep on going, brother.
Episode 3.
Keep on going. Okay, here we go.
Quite a popular text line we had today.
The B part is we're still not on it, so I'll give you the gist of the question.
My goodness.
One of our texters said, Jeff, we'd hear you talk about
all the time.
Don't pay tax on money you're not using.
One of your favorite quotes.
Dadism, no question. But
right.
That's like dadism number one.
Right. Stacking is not cleaning.
Thank you. And I'm not going to go to the last one. So people could be listening.
A lot of people could be listening.
Exactly.
They probably tuned out after our
by the
little
way,
technical difficulties.
FYI, Erin is a wonderful cook.
Why, thank you.
No, she had
You're trying to butter me up?
No, I'm still giving you a ride home.
Thanks.
She made my wife and I dinner last night, and
also my mom. This is my mom.
That's still my mom. 40 plus years, longer than your mom, and it was a wonderful dinner. So I just did want to mention that.
Why, thank you.
As an aside. So the question was, you're not real pro Roth conversion at this point.
Does that mean that you are not pro Roth conversion because you do not like paying money on taxes you're not using?
And the answer is that is absolutely true. I'm not pro Roth conversion.
Well, there are several very good reasons why.
Yeah. The primary one is it doesn't make any sense to me. So let me tell you one.
It's great.
No, it's true. If you are currently earning, if you're married,
okay,
if your adjusted gross income is over 90,000, a lot of people are,
sure,
especially if they're
married filing jointly. Yeah,
your effective tax rate is more than 10%.
Right.
If you're under 90, it's 10%. If you're over 90, it's over 10%. And if you're 100, 200, 300, whatever it would be, nice living, 100, whatever it would be, you're in a 15, 16, 18, 20 plus % bracket. When you retire, now again, I'm only going to use the 1,000 people that we've helped in terms of people we spoke to, but we've talked to in terms of clients with retirement. 99% of them have adjusted gross incomes of less than 90,000. So therefore, they're in a 10% bracket. So why would I want to pay taxes when I'm in my higher or highest tax bracket? So in theory, I could pull it out tax-free, whereas I'm going to be dropping down into a lower tax bracket or staying at the 10%.
Maybe we should
moving myself up to a higher tax bracket.
Well, maybe we should set this up a little bit, which is what is a Roth conversion? That's when you're taking pre-tax money that's usually inside of a traditional IRA.
Or a 401k
or
at
a
the time
401k.
You're moving it.
Right. And paying taxes on the money inside or a portion of it and moving it into a Roth account, which would then grow tax-deferred
as long as it's there
as long as it's there for 5 years, and then you get to pull it out without paying taxes on the growth.
As long as you're over 59.5.
Exactly. Also, this money passes on without taxes to beneficiaries. However, it still falls under that 10-year liquidation rule that traditional IRAs do.
And I would posit at this point that the most significant reason that I have found, even with our clients,
they want to pay the taxes for their children.
Exactly. They want to pay the taxes in advance for the kids. If that is your goal, then I'm behind you.
But there are also other...
If it's anything else, the truth is that it just doesn't make sense to pay taxes.
Well, right, because if you, just like your example said, if you are currently working, you are living off the net of your pay.
Yes.
But you are paying taxes on the gross of your pay.
Yes.
When you retire, the goal, at least our goal, is to fund to what you were living off of, which was your net.
Yes.
Now, you'll still pay taxes on the gross. However, the gross will be less because you'll need less money.
Well, yeah, I mean, because automatically 5.75%
is gone because you don't have to pay FICA.
As well as other...
Social Security tax and all that.
You don't do that anymore.
Right.
Also, you may be making a pre-tax contribution to health care. If you're using Medicare Advantage plan, that one goes bye-bye.
Also, you might have other ancillary benefits, short and long-term disability. Maybe you have AFLAC. There's a lot of constraints on your paycheck.
How about the big one, your retirement plan contributions to your 401k, your 403b?
The cool thing in retirement is you don't have to save anymore. You just don't spend the money.
Yeah, or you wouldn't be retired.
Right.
So when we get down to what is that net pay, what is the amount you're actually consuming? And again, we're assuming that you're not saving anything. So there are some people that out of their net pay, they actually save money.
Even more.
So we're getting this number down.
Right.
We have just found that with two people, or even one is easy, but two people, their Social Security benefits aren't all included in the calculation.
Right.
Are they combined gross over 90? And the answer is most folks aren't.
So that means that if you are working and you're considering a Roth conversion, all of the money that you are converting to the Roth is going to be added on top of your current income, meaning that you'll be paying more in taxes on the last dollar than the first, most likely. If you do not have the money to pay the taxes outside of the conversion, meaning you have money sitting in your checking account or your savings account or another outside of retirement plan account, if you convert $100,000 of IRA assets to a Roth IRA, if you have to pay taxes on that, not $100,000 goes in. So that means you'll lose the growth on those taxes that did not go into your Roth. 100 came from your IRA, but now only 70 goes into the Roth. Well, you've lost the growth on $30,000, which is another reason why we might say that's not the most prudent way to plan for taxes in the future.
Now, if you're a person, and it's possible, very probable, you're listening to our show, you've listened to other people's shows.
Many might have a different opinion.
Many have a different opinion. We don't have any opinion on their opinion.
That's a good point. We have our own opinions.
We have our own opinion. We will say that we have experience. If you're somebody that we do also have clients that are committed to do Roth conversions, and we say, okay, because that's their wishes. Do we recommend it?
Not in most cases.
No, Nanette. We don't do it. And does that make us wrong? Well, it's interesting. What I have found in working with folks, well, I've been doing it for 40 years now, but specifically in the retirement planning area for the last 20 plus years, there are very few things that are truly a mistake. Also, the tax laws change. Not doing a Roth conversion is not a mistake.
Also,
interestingly enough, when you look at things, you've heard the expression, maybe you've used it before, that hindsight is 20/20. Every decision that you're making today, every decision we're helping our clients make today, is all done in this moment. We don't know what's going to happen in their life, in the tax law, in politics, in the economy, even one day from now. But looking ahead 2, 3, 5, 10 years from now, you just don't know. So you make the best decisions today. And so all I can say is, at least what my driving factor is that never pay taxes on money you're not consuming immediately. That's a mistake.
Also, what's the goal of the goal of the Roth conversion? Because there's potentially, number one, it could be a non-issue for you, whatever you're trying to avoid. Number two, if you have a goal, then maybe we have a more efficient way of getting there. So, like we discussed, maybe one of the reasons you were considering a Roth conversion was because you wanted to be generous and prepay the taxes for your children on their inheritance. Traditional IRA assets are taxable. Roth IRA assets wouldn't be. However, there are other ways, and potentially for you could be less expensive to pay the taxes for your children,
right? And
without doing the Roth conversion. So
and we've talked about these periodically, and really, it's, if you're eligible and you're able to, life insurance can be a very effective tool. And truthfully, with most of our clients, they already have it.
Right. So we're now repurposing it from originally you created that life insurance because you wanted to pay a debt. You wanted a debt to be paid at your death, or you wanted to create income for your surviving spouse or family. But now that you're planning for retirement, you've already created the income and created the capital for yourself. So maybe we repurpose that life insurance to maintain your capital after your death as opposed to have it taxed. So there are... have it taxed more.
No, honey, you're 100% right here. And I will say that these days, we have typically two types of life insurance discussions. One is, I have this policy, I've had it for all these years.
Do I keep it?
There's a bunch of cash in it. What should I do? The second one is, and with a lot of cases of those, we find people are still paying premiums, so they don't have to. So we change the dividend option. They stop paying premiums, so they go to tax-free thing for their kids or spouse.
Well, it's just looking at at what you have and seeing if we can improve upon it.
Right. The other side is term insurance. A lot of folks have bought term insurance. They don't want to invest in any type of permanent contract. Don't necessarily disagree with them. But what happens is they get to a point where they're in their late 60s, mid 60s, late 50s, early 70s, and it's called, you know what? Now I got to make some decisions here. do I want to, as Aaron was saying, help pay the taxes for the kids so they can get my IRA, which I wasn't taxed on? Do I keep a portion of this because I want to create maybe a gift to a church or gift to my grandkids or whatever? Maybe I still need it for capital purpose for a spouse. All these decisions are all integrated together.
Right.
And none of them happen to be called Roth conversion.
Well, I think that the Roth conversion, just like life insurance, just like any other financial product, is a tool. A Roth conversion isn't an actual product. It's an option you have, but it's a tool to get you somewhere. It's not the solution to anything. No. So first we really need to know what your goal is, and then we find the tool to get you there.
Yeah, and it's certainly fun. So really good question from our texter, and we do appreciate that one, and that's one that we don't get often in the office because, folks, all the people come visit
because
us
you have a very strong opinion.
Yeah, I do.
We have some more text questions that have rolled in.
This is wonderful.
Right?
Go for it. And again, our phone lines are open. We'd love to hear from you. 931-5877, star 5877 from your cell phones, or 84126 from the text line.
Is it possible to extend COBRA 2 months past the 18 months? I was terminated before I was ready to retire and will be 2 months short to bridge to Medicare when done with the 18 months of COBRA. Unfortunately, no. They will not allow you to extend the COBRA any longer than the 18 months that you have available to you.
Sorry, Chucky.
So you might want to consider taking a look at individual health insurance to get you that 2 months.
Which is no big deal. It's guaranteed issue.
Right, it'll be guaranteed issue for you because you'll be losing your COBRA coverage. It'll only be for 2 months, so you might consider in a lot of cases when things don't match up perfectly. What we have done is we take a look at people's health, their physicians and their prescriptions, just like we would if we were planning for Medicare. But in a lot of cases, what we're doing is let's find the highest deductible policy available because we want to create financial protection in case something happens. Still want you to have access to be able to fill your meds or if you need a doctor's appointment. But we don't need we don't need an incredibly low deductible pushing the premium price up for 2 months because we know there's a light at this end of this very short tunnel, which will be Medicare for you.
I mean, the big issue is your deductible if you satisfy any of it doesn't carry over to this new contract. So, sorry.
Right. So you might want to consider if in this 2 month window here, trying to hold off on routine medical care because you don't want to pay into a deductible that you're going to have to sacrifice just 2 months from now.
That's great. And we do have Charlie on line one that has a Social Security question.
Yeah. Recently, my sister's husband died, and the other day she got a check from Social Security titled as a widow benefit. Now, will she receive that same check every month?
Well, did she apply for the survivor benefit, or was this check to around $300?
It was like $250, I think she said.
Okay, so that is the death benefit that Social Security hasn't changed since they created it. So it's like the burial benefit associated with.
That's a one-time benefit.
That's a one-time benefit, but she does potentially have the option if she's over the age of 60 to apply for the survivor benefit, which would allow her access to her late husband's Social Security benefit, and that would continue on.
Yeah.
Okay, I got you. Okay,
and
so
what,
I'll just...
Right, exactly. And what would happen at that point is that if she did, and she should contact them, because she has to stop her husband's Social Security benefit if he was receiving it.
Right.
Her benefit, if it was less...
Well, they obviously know he passed away already.
Right.
Because they sent the burial benefit.
Thank you, babe. I'm a little thick this morning. Her benefit would step up to his benefit.
Correct. If she was receiving a lower benefit.
And she's not getting his benefit anymore because
right.
He just got the check, right?
Right.
Very good. Good question. We do appreciate that, Charlie, and have a great day. Hope it helps your sister.
Yes. So they haven't adjusted that benefit for inflation in any way, which is why it's such a low amount, unfortunately.
I was going to say, I would think that Social Security probably, I don't know if they would automatically, but if she's already applied and gotten the survivor benefit.
Well, I don't believe that she applied for the survivor benefit. It sounds like they may have just contacted Social Security, let them know that he passed away, which is why she received that one-time payment of the burial benefit. And then you have to call and actually request the survivor benefit, which, just like you said, the way it mechanically works is they just increase the surviving spouse's benefit to whatever the deceased spouse's benefit was, if it was greater, and then you get that number. You don't get your benefit plus his benefit.
Yeah, and they used to do like half of one, half the other. So
right.
All that stuff
but at the end of the day, you just
gone.
get the same, right?
Yeah, you get the greater of the two.
Exactly.
Which actually is what should happen.
More questions.
This is great. We're like marathoning today. Let's
I
go.
know.
Wonderful.
My question is about the initial meeting. If we come to you 5 years before retirement, do you give suggestions for changes we should do that will make our situation better at retirement? And do you advise if we can actually retire sooner? Well, we certainly wouldn't want you to work longer.
Yes. Yes. I think there were 3 questions.
Yes.
So I'm going to say yes, yes, and yes. Why don't you embellish on that?
My pleasure.
Because you get to meet the Aaron first, actually.
Your pleasure, not.
Yes.
All right. So if you come and see us 5 years before retirement, that would be fantastic, because really that way we get to.
Uber. I just want to let you know.
Call what?
That was an Uber event. There.
What was an Uber?
That was an Uber comment right there. You got to walk home now.
It's an Uber comment. I thought you meant like Uber. Like, that was a great comment, over the top.
No, I'll miss you.
That's nice. Mom will come get me.
So you do come visit.
Yeah, you do come visit, and you come well in advance of your planned retirement.
We love
that is great, because we can really help, like you mentioned, suggestions for changes, or maybe a little cheerleading on the excellent things that you've done, and, maybe take a look at what you're currently doing and see if we can tweak it a little bit to help you get to where you want to go faster. Or maybe you realize that you thought you came in 5 years before retirement, but really you have a lot more options open to you. So yes, our goal is to get you where you want to go as fast as you can.
And it's really, the coaching session is fun. We do have our 6x8 foot computer whiteboard, and we do like to play This Is Your Life. So what we're going to do is say, hey, what happens when I retire? What if I do want to do it early? When should I take Social Security? Which options make sense for us to consider electing when it comes to our pension? So all of those conversations we're going to have, also including, the estate planning questions. How do we pass on assets to the people that we love? How do we protect our assets from long-term care, those type of things? All that's in a coaching session. And as I like to say is, we're building this road. I think of it as Yellow Brick Road because it's one of Aaron's favorite movies. And so every time that we're visiting, as we're getting closer and closer, we're just adding more bricks into this road, so that when it comes time that you decide, hey, we're going to pull the trigger, you're just feeling very comfortable. Let me use an example. Honey, you were in the middle of your 2-week off of work recovery period a couple weeks ago, and I had met with somebody, and I sat down with them, and it was a couple very nice. Mm-hmm. And I'm looking at their questionnaire, and they go, and it says, we have one, and basically we have one child, adult child, and they live in Kentucky. So my first question was, when are you moving? And they said that, how did you know? I said, this is what I do for a living. I can tell you, I have a child. It's in Kentucky. Most people want to be near their kids, especially when they're retired. They have the time. They want to get more involved in their lives, in their grandchildren's lives, all that, if they have them. That wasn't it. See, I wasn't even a grandchild dig for the day.
I'm currently researching a texturer's question, so I was not listening to your dadisms.
Thank you. So anyway, so we're having this conversation, and we went through, we did their game plan. They were thinking about retiring, let's say, actually it was going to be 2 years from now. We're looking at the numbers, do we take Social Security? What's the difference? How much income do we need? Where are the holes? When we finally got done with this, I looked at them and said, you can leave when you want. Healthcare wasn't an issue for them. They had COBRA. They could make it. They could take it 18 months and get into Medicare. It was a question of desire. Was he and she really ready to disengage from their work? Did they want to give up the money? Did they want to give up the social situations? What was it with their kids? Had they had time to go and look and try to find other housing, et cetera, et cetera, et cetera? So I said, you'll let me know. Right now, our target date is 18, 20 months from now. So I get a call last week that said, you know what? We're out of here.
We're out of here.
No, they said we're out. July 1, we're out of here. After the coaching session, we went down. We saw our son. We stayed at his house for a couple of days. We started checking out the place. We've rented a place. Took my advice on that. Don't buy anything. That's a big deal. That's a big deal for me also. If you're going to move to a new city, I don't care if you visited it 30, 40 times. When it comes to living somewhere, where are your doctors? Where's the gym? Where are the restaurants that you like to frequent? Where's the Y, the health club, the whatever? Where's your synagogue? Where's your temple? Where's your church? You don't know any of this stuff. Purchase a home at someplace you don't know, and then it doesn't make any sense. Rent. So anyways, they took my advice. They rented a place for a year, and they said, you know what, we're just going to keep looking. Housing market is going to go crazy by then. We'll find a place. And if they do find a place beforehand, hey, you know what, the cost of rent wasn't that big deal, so they'll blow a few months off and they'll do their thing. But it was just fun because all that came from the coaching session.
Right.
I mean, so if, as Aaron was saying, you may think that you're 5 years out, but the truth is you may not be. I would say that 90+%, honey, is that fair? Plus percent people that walk in our office, they think they can retire. They just need
some confirmation.
Confirmation and also help in making that next step. As well as in many cases, helping on the investment advisory side. That's how they pay us. And then obviously just the game planning, helping them get all the pieces of the puzzle into place, in order, timing correct, things done correctly. And so it's fun. It's obviously for us, it's a blast. We love doing it. We love talking about it. And we love the fact that there are people out there listening. We'll see you next week or when you call us.
You know what I love?
To.
You know what I love? Clever people. We have a texture that's real clever.
Okay.
So clever that I don't know the answer to this question.
I love that. Well,
if I am 64, I am 64, rather, he said. It's not a question. I'm 60.
That's not like a Beatles song, right? Well, I'm 64.
No, it's not a theoretical. I am 64. I would like to start taking Social Security. I have a job where I make about $30,000 per year. Yep. Here's where the clever part comes in.
Clever.
If I defer $26,000 into my 401k, so my taxable income is $4,000, would I be able to draw Social Security without the take back? So essentially, is the income limit based on gross or is it based on taxable income? And I have been on the Social Security Administration website, and the not bizarre, but the inconclusive thing is they only say earnings.
Right, because what will happen, honey, I believe that he could, because what happens is that when he gets his W-2, it won't show that. It's going
to show Social Security earnings.
Yes, exactly.
So, unfortunately, that was super clever. But you'll be subject to the take-back. However, the take-back is nearly $18,000 this year, so that means that $12,000 of your income would be subject to the take-back.
And if you're 64 now, that means your normal retirement
probably 2 years from now.
Yeah, it's like
a year
you're probably 66 or 66 and 2, because I know I'm 66 and 6. So that being the case, that was a clever question, but
it was a clever scheme. I like it.
The Internal Revenue has clever people.
Well, like that, right? Exactly.
When they create these rules, and so that was very good thinking. But sorry, Chucky.
Right, because if you look, that's a good point. If you look at your W-2, it says tax, Social Security, wages.
Yep. But ask your CPA.
I just like people are always trying to think about the tax law and how they could use it to their advantage.
Yeah, so we like the word of creativity versus scammers. So it's cool.
It's not a scam.
No, it's not. When it's about you, it's not a scam.
Following the rules to your advantage is never a scam.
No, it isn't.
Exactly. So we're
the IRS has thought about this.
They have infinite time and money to think about these things. Unfortunately. But yeah, that was a...
has our text line run out for today?
It has run dry for the moment.
Well, good. I thought we've done a pretty long and reasonably extensive healthcare.
Yep, there have been quite a few healthcare questions.
Which those, that part of our show is always...
riveting.
and also sponsored by our very good friends.
Oh, yeah, of course. Sponsored by Aetna and Anthem of Missouri.
Thank you very much to the two major insurance companies that do sponsor our show. We appreciate that. I was going to say, if it's okay, what I would like to do, honey, is let's go to Stan the Man. We have about 5-6 minutes left, so you
All right.
can call us 931-5877 *5877 from your cell phones, or 84126 from the previously jammed but now open text line. Stan wrote us. He's 52 years old, and he recently inherited money from his father's estate. Unusual. Usually dads go first and moms are later. What taxes are due, and what should I do with the money? Pretty good one. So let's talk a little bit about the assets that Stan inherited and how they're dealt with on a tax basis.
Okay. So looks like Stan's father had about $65,000 in CDs. Those will be tax-free for you.
That's right. And the interest itself that had accrued would be tax-free.
Right.
Because you get a step up in basis to the fair market value of those under the current tax law, what they're trying to attack, which everyone will be writing their congressman if they actually get this into a bill, okay, because it's wrong.
You heard it here first.
No, it is. I mean, this is an incredible attack on your wealth. You
pay taxes on the money to invest, and then
you pay it on the interest, you pay it on the dividend, you pay on the capital gains,
and now you're going to be taxed on it again. It's another form of a death tax for people that are under the estate tax limit. So this means that, like, even people that are passing on small amounts of money, but relatively small amounts of money. It wouldn't be small for you if you were receiving $100,000, $200,000 necessarily. But if you're receiving that outside, so in this example, if you're receiving it outside of a retirement account, then that means all the growth. So let's say mom or dad bought Coca-Cola 50 years ago. At the cost basis was $1, and now it's whatever the share price is.
About $45 a share.
Right, you would owe it if you sold any of those shares. $46 would be taxable to you
as a
long-term capital gains. Whereas now,
assuming you had the basis in the stock, which would be nice because most people don't, because mom and dad have for so long.
Which means then 100% of it would be taxable to you if you don't have the basis. But
it's
the
dead
way
wrong.
that
it's just dead wrong.
Right, the way that the rule works now is, for example, like with Stan, if he had inherited that $100,000 of Coca-Cola stock, he would get a step up in basis to the date of dad's death, meaning that becomes his new basis. There's no taxation on it. He'll only pay the difference in the taxes when he makes sales, if there's any gains.
Yes.
From that point forward.
And that's been a very important part of the tax law for many, many years. And
it really protects people that, aren't monstrously wealthy, but they're passing on nice amounts of money that they've worked for their entire lives to their children. And why do we need to tax it again?
Honey, again, we're not just talking about financial assets.
Absolutely.
We're also talking about
homes,
land,
farms,
family farms, which we deal a lot with.
There's some century farms around.
That's right. Generational changes. Mom and dad were farmers. You're not. They're selling the property.
So this is not an attack on the wealthy. I feel like this is really an attack on the middle class, because those are the people that are going to suffer the most from this tax change.
Yes, they would. And so we don't like that. We don't like any increase in taxes. Now, Stan also is inheriting $134,000 from dad's IRA, which is now taxed differently, too.
That's right.
Subject to being taxed
differently. Either Stan is going to have to decide to liquidate that all at one time, pay the taxes, or liquidate it over the course of a 10-year period and pay the taxes as he goes. You don't have to take equal amounts over 10 years, but by the 10th year, the account balance needs to be zero.
Okay, two more quickies. He had a Roth of $26,000. What's cool about Roths is
no taxes. He
inherits it tax-free, but he is still subject to the same distribution rules as a traditional IRA, which means he has to take it out within 10 years. And the last one is he inherits a home, $185,000. It's tax-free. It's tax-free because
unless the price at the date of sale exceeds the fair market value of the date of death of his father.
So right now, inheriting money is fun.
Well, it'll still be fun.
Let's keep it that way, shall we? Well, no, I mean, really, there's certain things they're going to look at, and it's okay to look at these things, but there's certain things that they really should be very careful.
Where's the greatest impact? And this seems to be negatively affecting people with smaller estates.
It's
in
all
my
about,
opinion.
It's all about increasing your wealth, and we can talk all about these at coaching sessions if you like. They're fun. They're free at our offices, 314-863-0008. Again, 314-863-0008. See you next week.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
This is Jeff Lapidus, the Retirement Coach. We'll be back next week at 10 a.m. here on the Big 550 KTRS.